At first glance, it looked like another episode of American assertiveness. Statements were issued, strategies announced, allies briefed, markets reacted. Commentators spoke confidently about pressure, leverage, and red lines being drawn. Yet on the other side of the Pacific, something unusual happened. Nothing. China did not escalate. It did not counterpunch. It did not rush to dominate headlines or reassure nervous investors. Instead, it absorbed the moment quietly, almost invisibly, while Washington spoke louder and moved faster. To many observers, that silence looked like hesitation. To seasoned strategists, it looked like intent. Here is the uncomfortable question most coverage avoided. What if China wasn't falling behind but stepping aside? What if restraint itself was the move, designed to let costs accumulate elsewhere? Recent months make this question harder to ignore. As trade flows adjust, capital reallocates, and diplomatic fatigue sets in, the weight of action has not been evenly shared. One side has paid immediately, publicly, and politically. The other has preserved flexibility, options, and time. This is where surface narratives begin to fail. Power is not always the actor on stage. Sometimes it is the figure waiting in the wings, letting momentum turn into burden. To understand what happened, we have to stop reading noise as strength and start reading silence as strategy. For decades, global geopolitics has been narrated like a stage play. Power belongs to the actor who moves first, speaks loudest, and occupies the most space. Sanctions signal resolve, tariffs demonstrate toughness. Aircraft carriers, emergency summits, and televised announcements become proof that control is being exercised. In this worldview, visibility equals authority. Western audiences and financial markets are deeply conditioned by this logic. Escalation is read as confidence. De-escalation is framed as retreat. When governments act forcefully, headlines reward them with urgency, while restraint is often interpreted as weakness or confusion. The faster the response, the stronger the hand appears. This framing shaped how recent U.S. actions were received. Policy shifts, strategic signaling, and public pressure campaigns were widely described as cornering China, forcing decisions, exposing vulnerabilities, and narrowing Beijing's options. Analysts spoke of deadlines, red lines, and moments of reckoning. The assumption was simple: action creates advantage. But this narrative carries a hidden bias. It assumes that all players measure time, cost, and risk the same way. It treats speed as efficiency and reaction as dominance. It overlooks a critical possibility that absorbing pressure can sometimes be cheaper than answering it. Markets are beginning to reflect this tension. While volatility has followed visible moves, quieter adjustments elsewhere have gone largely unnoticed. The story most people see is the one being told out loud. The story that matters may be unfolding on a much slower clock. And as current data emerges, that slower clock increasingly shapes outcomes, even while attention remains fixed on the noise of immediate confrontation and short-term political incentives. China's approach to power has rarely been about speed. It has been about endurance. Where Western strategy often rewards decisive action and immediate results, Beijing's playbook has long favored delay, absorption, and strategic waiting. Pressure is not always answered. Sometimes it is invited, observed, and allowed to mature into something costly for the sender. This logic is deeply rooted in financial history as much as statecraft. In markets, the most dangerous moment is often when everyone is forced to act at once. Those who can wait, who can remain liquid while others commit, inherit flexibility. China applies this same principle at the national level. By resisting the urge to respond publicly or aggressively, it transfers uncertainty outward. Restraint in this framework is not passivity. It is a method of risk management. Every visible escalation carries political, economic, and reputational costs. By not matching those moves in real time, China avoids locking itself into positions that later prove expensive. Instead, it lets opponents reveal their tolerance for pain first. Recent updates reinforce this pattern. As global growth slows and capital becomes more selective, optionality has become more valuable than dominance. China's slower posture has preserved room to maneuver, while others face domestic backlash and market fatigue. The key insight is simple but uncomfortable. Time itself can be a strategic asset. This is not about ideology or moral superiority. It is about sequencing. When one side feels compelled to move and the other does not, power begins to shift quietly. To understand what happens next, theory alone is not enough. We have to examine how this patience interacted with very real decisions made elsewhere. As pressure mounted, the United States chose visibility. Economic tools were deployed, alliances were signaled publicly, and messages were crafted for markets as much as for rivals. Each move was intended to demonstrate control, resolve, and leadership, but together they created something less obvious: exposure. Economic pressure carries domestic costs. Alliance signaling creates expectations that must be maintained. Market messaging narrows policy flexibility once investors price it in. Over time, these commitments began to stack. Every additional step raised the political and financial price of reversing course. China did not interfere with this process. It did not need to. By staying largely reactive, it allowed these pressures to compound naturally. The asymmetry became clear, one side paying upfront in volatility, subsidies, and diplomatic capital, the other letting time amplify those costs. Recent developments underline this imbalance. Policy fatigue has emerged in Washington, while allied coordination has grown more complex. Meanwhile, China has retained the ability to adjust quietly, responding selectively rather than comprehensively. The trap was not a single decision, it was the accumulation of obligations. This is the danger of overcommitment. Initiative can quickly become liability when circumstances change. By acting first and often, the United States reduced its own room to maneuver. China's restraint, by contrast, preserved strategic depth. That difference now spills beyond politics and into the economic system itself. Geopolitics ultimately settles in markets. Supply chains respond not to speeches, but to incentives. Capital flows towards stability, not declarations. As tensions increased, firms and investors began adjusting quietly, often in ways that favored flexibility over alignment. Supply chains diversified, but not always away from China. Many companies chose redundancy rather than exit, keeping Chinese capacity while adding alternatives elsewhere. This preserved China's role while shifting costs onto firms navigating complexity. Investor uncertainty followed visible political action, increasing volatility where commitments were loudest. China benefited by not forcing outcomes. By allowing global actors to adapt organically, it avoided triggering panic or capital flight. Recent data shows long-term investment becoming more selective, favoring environments where policy appears predictable rather than performative. The lesson is structural. Markets reward patience because it lowers risk premiums. While headlines focused on confrontation, balance sheets reflected something else entirely. And as current conditions tighten globally, the advantage increasingly belongs to those who let economics, not rhetoric, do the work. Only now, with some distance, are the results becoming visible. Trade flows have begun to settle into new patterns, not through dramatic decoupling, but through quiet rerouting. Chinese exports have shifted destinations, while imports of critical inputs have diversified just enough to reduce vulnerability without signaling retreat. At the same time, alliances once framed as unified fronts are being recalibrated. Partners face domestic pressures, fiscal constraints, and electoral cycles that make long-term confrontation harder to sustain. Recent policy signals reflect this reality. Softer language, narrower objectives, and an emphasis on stability over escalation. China's earlier restraint preserved something invaluable in this environment: optionality. Because it did not overreact, it retained the ability to adjust incrementally as conditions changed. Others, having committed publicly and politically, now face higher exit costs. This is why the trap is only clear in hindsight. What looked like passivity was patience compounding. What looked like momentum was exposure accumulating. As growth slows and capital tightens, the advantage shifts toward those who conserved flexibility when it mattered most. Current data points from trade balances, currency stability, and investment commitments quietly reinforce this shift, even as public debate remains focused on yesterday's confrontations rather than today's incentives, and the strategic patience that shaped them continues to pay dividends now. At a deeper level, this episode reveals a shift that extends beyond any single country. In modern global finance and geopolitics, power increasingly lies in the ability to make others absorb volatility. Those who move first often inherit uncertainty, while those who wait let risk travel outward. This marks a break from older models of dominance. In the past, scale, speed, and visibility defined strength. Empires expanded, markets were conquered, and control was demonstrated publicly. Today's system is denser, more financialized, and far less forgiving of overextension. Quiet endurance now competes with loud dominance. States that preserve balance sheet strength, policy flexibility, and narrative restraint can outlast those chasing constant leverage. Financial history offers parallels, from over-leveraged great powers to patient creditors who shaped outcomes without spectacle. What we are witnessing is not weakness replacing strength, but a redefinition of it. The ability to wait, to let others reveal constraints, and to avoid locking in losses has become a form of influence. This case is not unique. It is illustrative. As volatility becomes a permanent feature of the global system, the advantage will belong less to those who command attention and more to those who manage exposure. It suggests that future contests will be decided less by dramatic moves and more by who can endure uncertainty longest without forcing irreversible commitments, while rivals exhaust themselves under constant pressure and public scrutiny worldwide today. At the beginning, we asked a simple question that challenged the headlines. What if the most important move was the one we never saw? With time, the answer has become clearer. The decisive advantage did not come from escalation, but from restraint. This episode shows how power can be exercised by refusing to rush, by letting others commit first, and by allowing pressure to mature into cost elsewhere. What appeared to be inaction was, in fact, a decision to let the system work. The implications extend far beyond this case. Future conflicts in finance and geopolitics may hinge less on dramatic confrontation and more on who can preserve flexibility longest. The winners may be those who accept silence, uncertainty, and delay as tools rather than liabilities. In a world addicted to reaction, patience becomes disruptive. And as this story suggests, the terms are often set not by the loudest actor, but by the one who waited. As current conditions evolve, this lesson grows harder to ignore, offering a lens through which to read future power struggles long after headlines fade and narratives change, leaving only outcomes behind for historians and markets alike globally.